Hello everyone, welcome to Applied Finance Simplified. As the financial year end fast approaches, one thing is surely on the top of our priority list, and that is tax planning and investments. Today we'll discuss some strategies that will help you save taxes on your capital gains from investment in either equities or equity-oriented mutual funds. These strategies will help you to optimize your post-tax return on your portfolio. If this interests you, listen in. Before we discuss the strategies that will help you save tax on capital gains on equities and equity-oriented mutual funds, we first need to talk about what are the kinds of capital gains that arise on sale of equity or equity-oriented mutual funds and the applicable tax rates thereunder. There are two kinds of capital gains. One is the short-term capital gain and another one is called the long-term capital gain. The capital gain types depends on your period of holding of the capital asset. So if you hold equity shares for a period of more than 12 months period, the gain that arises to you will be classified as long-term capital gain. And if you hold the shares for less than or equal to 12 months period, the gain that arises to you will be classified as short-term capital gain. Let's take an example of short-term capital gains and how tax is calculated on it. Suppose you bought 100 shares of a company on February 1st, 2021 for 2000 per share from Bombay Stock Exchange. And these were sold on March 19, 2021, that is after a period of over 1 month for Rs 2,300 per share. Please note that short-term capital gains is taxed at a flat rate of 15%, plus the surcharge whichever is applicable to you and cess, that is HEC at the rate 4%. So let's calculate capital gains here. Your sales consideration is 2,300 per share multiplied by 100, so which makes it 2,30,000. Your cost of acquisition was 2 lakh rupees. So your short-term capital gains is 30,000 rupees. Tax on short-term capital gain at the rate of 15% is 4,500. Now let's talk about long-term capital gains on listed shares and units of equity-oriented mutual funds. So as we have already discussed, if you hold equity shares for more than a period of 12 months, then the realized capital gain will be long-term capital gain. Long-term capital gain is taxed at a flat rate of 10% plus applicable surcharge and cess, but you do not get benefit of indexation. Long-term capital gain up to Rs 1 lakh is totally free or exempt. So when you have a capital gains of over 1 lakh, only that portion of the long-term capital gain over 1 lakh will be charged to tax. Let's take an example to understand the long-term capital gains and how the tax is calculated. Suppose you bought 100 shares of X Limited for 1,800 on May 10, 2018 and sold it on March 19, 2021 for Rs 3,000. As your period of holding is more than 12 months, your equity share holding will be classified as long-term asset and hence resulting gain will be classified as long-term capital gain. So the sales consideration here is 3 lakh rupees and the cost of acquisition of these shares was 1,80,000. The resulting long-term capital gain is 1,20,000. Up to 1 lakh, the long-term capital gain is exempt from tax. So you will charge 10% on only the excess over 1 lakh, that is 20,000 multiplied by 10%. So your capital gains tax is 2,000 rupees. Now let us talk about tax harvesting. The aim of tax harvesting strategy is to reduce or minimize our long-term capital gains tax liability. We can apply tax harvesting in two ways. One is the tax gain harvesting and another one is tax loss harvesting. So let's talk about the capital gains tax gain harvesting first. We are trying to take the benefit of the basic exemption limit of Rs 1 lakh for the long-term capital gains. So we intend to harvest the Rs 1 lakh capital gains each year. So over the long period, our capital gains tax liability is reduced. Let us understand this with an example. Let us take a simplified example of tax gain harvesting. So we have two scenarios here. One is in which the tax harvesting strategy is applied, and one is without tax harvesting strategy. So let's understand. If we invested initially rupees 4 lakh and bought 4,000 units of a mutual fund when the NAV was 100, after a year, that is after you clock the 12 months period is over for it to be declared a long-term capital gain, the portfolio has grown 15% to 4,60,000. We sold all the units and repurchased it at the same day. So the harvested value is 4,60,000 and the long-term capital gains in this case is 4,60,000 minus 4 lakh, that is 60,000. Since 60,000 of gains are under 1 lakh, so there will be no capital gains tax liability. And we sold this and we harvested back the principal as well as the gains into the same units. In case of without tax harvesting, we did not do anything. The portfolio remains as is with the funds already reinvested. At the end of the second year, let's assume that the portfolio grew by another 20%. So in this case, the value of the portfolio became 5,52,000. We applied the same strategy. We sold all the units and repurchased all the units. So in this case, the harvested capital gains comes to 92,000. The long-term capital gains on 92,000 is again nil because it is under the exemption limit of rupees 1 lakh. In the third year, after the portfolio, we have assumed that is again grown at 15%. Now this year, after the 3-year period, we have decided to redeem the portfolio. So the value of the portfolio is 6,34,800 and the capital gains realized in the third year are 82,800 and these are again below 1 lakh limit, so we pay no capital gains tax liability. This when compared to the scenario where we have not utilized tax harvesting, you will see that the initial investment of 4 lakh after a 3-year period has grown to the same amount of 6,34,800 in both the cases. But when tax harvesting is not applied, we realize the capital gains are after the end of 3-year period of 2,34,800. So capital gains will be levied on 1,34,800 at the rate 10%, which is 13,480. So the same portfolio, in one scenario we paid no tax during the year, where in other scenario we have to shell out 13,480 rupees. Now friends, this is a very simplified example, but helps you understand that how taking the benefit of the exempt limit of 1 lakh per annum will help us save taxes in the long run. Now let us talk about the tax loss harvesting. This strategy helps you to take the benefit of set-off of the losses against the capital gains that you may have made during the year. The tax loss harvesting can be applied to get you out of a wrong asset allocation and can also be applied to rebalance your portfolio. Tax loss harvesting starts with identifying the stocks or units of equity funds which is experiencing a consistent price decline. And you have a strong belief that the security has lost most of its value and there are no hopes of recovery of this loss. Well, if that's the case, you can sell the shares that are making losses and use these losses realized to set it off against the capital gains that you may have made in your portfolio. This will help you maximize your post-tax returns. Let us take an example of tax loss harvesting. Let's say your portfolio has made short-term capital gain of 1,50,000 and a long-term capital gain of 2 lakhs in the financial year 2020-2021. And you have realized that your portfolio also has a chance to book a short-term capital loss of rupees 80,000. Let's work out the tax liability in case when you harvest this loss and in case when you do not harvest this loss, and let's look at what is the tax saving. So in our case, we have taken these two scenarios. The short-term capital gain in both the cases is 1,50,000, long-term capital gain 2 lakhs, And in tax loss harvesting scenario, we have assumed that we sold our loss-making investment and realized 80,000 as the loss amount. Now when we calculate short-term capital gains tax, we can exclude from 1,50,000 gains the 80,000 loss that we realized because of the set of provisions. So we calculate on balance the tax rate 15% and our tax liability on short-term capital gains works out to be 10,500. Long-term capital gains in excess of 1 lakh will be charged at 10%. So 2 lakh minus 1 lakh limit at the rate 10% gives us 10,000 long-term capital gains liability. So our total tax liability under tax loss harvesting option gives us 2,500, which when compared to when no tax loss harvesting is applied is 32,500. So we save whooping 12,000 rupees by applying tax loss harvesting strategy. Let's understand some things that we should keep in mind while applying tax loss harvesting. Use this strategy to get rid of your bad investments which have minimal hopes or no hopes of recovery at all. Try to sell those loss-making stocks or funds that no longer fit your investment strategy. Use tax harvesting as a tool not only to save your taxes but as an option to rebalance your portfolio so that you can meet your desired financial goals. Last but not the least, please do all these strategies after taking into account your brokerage cost, other taxes that you might have to pay, other transaction costs, and most importantly, in consultation with your investment advisor. We also need to know what are the set of rules before we end. So short-term capital losses can be set off either against short-term capital gains or long-term capital gains. So please remember, as short-term capital gains are taxed at a higher rate of 15% as compared to long-term capital gains, we should try to first set off the short-term capital losses against the short-term capital gains. Long-term capital losses can only be set off against long-term capital gains. Capital losses can be carried forward for set-off up to 8 years. Please remember, for carrying forward of the losses, you need to file your return of income before due date of filing return of income and declaring these losses in that return of income. Hope you find this video helpful. If you do, please do like, share and subscribe. Take care of yourself. Thank you.